open bracket, and you say investment property, close bracket. You're saying, since the commercial building is an investment property from which a file earns rental income,
All right, guys, good evening. Good evening, online people.
Good evening.
I was seeing people saying that two a day. I don't know what it means. People thought that we had already started class. We are just starting now. So welcome back. I think we last met on Wednesday. It's just one day in between, and it is like a month. That is how much I missed you. Okay, guys, the last time we were here, we had unleashed the concepts and the accounting treatments of what? Of discounts and returns, not so? Yeah, that's what we had looked at, and I think we had only looked at discounts. Just a small recap. We say that discounts are divided into two. Discounts allowed and discounts received. Now, before that subcategory, we have a major category. We have trade and what? And then
Trade and cash. And cash.
And then we said that the trade discounts, they happen before the transaction has actually even occurred. So no accounting what?
Entry.
So cash discounts are divided into two. That is the discount allowed. And then the one that is received. So we allow to customers and we receive from suppliers. Okay, since we are allowing to customers, then this one, by all means, it has to affect our trade receivables, not so? Yeah, it will affect our trade receivables. And this one from a supplier, it will automatically affect our trade what? Payables. And the effect is not so much. The effect is that either way, it will reduce them. The discount allowed will reduce the trade receivables, isn't it? And then the discount allowed will reduce trade what? Trade payables. So under all circumstances, it will reduce. It must reduce them. All right, so we said that where everything starts, if it is a discount allowed, it starts with the occurrence of a credit what? Of a credit sale. After this credit sale has occurred, say of Uganda shillings, 20 million. We simply say that because of the credit sale, the entries that we have to take in our books of accounts are debit our trade receivables, and then credit our sales account. Yeah. Crediting our sales account because they are incomes, trade receivables, those are assets. They are representing a right to receive. Since we have not received yet, we have earned. I don't want to bring those concepts now. If we have not yet received, yet we played our part, we just recognize.
Something.
Irene, kindly mute. Irene, kindly mute. So, debit trade receivables, credit the sales account. Both with Uganda shillings, what? I hope all of us are okay with this, isn't it? Are we all okay with these journal entries? Okay, now, after that, at the point of settlement,
You're going to write.
Irene, Kuhebwa, kindly mute. Okay, at the point of settlement, we said that since we recognize a right to receive, once this person settles, assuming that in our contract we agreed that if they settle within a specific timeline, which they have met, we shall give them a 2% discount. A 2% discount. If this is what our contract actually stipulated, and now they are paying in the same timeline, then it means that we have to give them the discount, and at the same time we have to do away with the receivable. Are we together? Because the receivable was representing a right to receive in the future. Now that we have received, we have to do away with the right. Isn't it so? So that is number one. You debited the trade receivable representing the right to receive. Now that we are de-recognizing it, we have to do what? We have to credit. Are we together, guys? So we are crediting the trade receivables. That's what we said last time. But you recognized it at 20 million. So you have to remove it at 20 what? at 20 million. Are we together, guys? However much you're going to receive less, you cannot write down the receivable by less. Because if you write it down by less, it will be showing as though you are still demanding them some money, which is not actually the case, isn't it? Isn't it so? Okay, so I'm crediting trade receivables with everything that I had recognized before. And then I have to recognize the amount of money that I have received. So since we are giving a 2% discount, how much is that discount? The discount is 400,000. So we are receiving it in terms of maybe cash. Are we together? So meaning cash is now the money. Are we together? That we are receiving. We didn't receive it before, but we are receiving it now. So being an asset, cash shall be what? Shall be debited because it is increasing. We are recognizing cash. Okay, cash of how much? 19.6 million. Okay, and we are saying that the difference there that we have not received is a discount that we have allowed. Are we together, guys? The discount that we have allowed. And a discount allowed is an expense. Are we together? Discount allowed is an expense. And I think you can even see it from our definition of an expense in the first place. We say that an expense occurs as a result of a reduction in an asset or in an increase in a liability. Are we together? So if you can, if you're to look at this entry closely before we do even anything else, you're seeing that we had a receivable of 20, but we have actually realized only 16. Are we together? So meaning our assets, overall assets that we had of 20, because under normal circumstances, if we had a receivable of 20, we are supposed to get cash of 20. But because we are receiving less cash, it means that our asset has decreased. And because of that decrease, we recognize an expense. Are we together? So that is another way of trying to make sense out of that entire transaction. But even if you don't go there, you clearly see it that we received less money and we gave a discount. Discount allowed is an expense. So we have a discount allowed of 0.4 million. And if you're to look very closely, our total debits are 20 what? 20 million. Our total credits are 20. That is what double entry says. That every debit, there must be a corresponding equal but opposite credit. TA, TA mute. Kindly mute TA. I don't know who TA is, but mute. TA, please TA kindly mute. Save time. All right. Is it okay? That's partly what we ended with last time. And we also looked at a discount what? A discount received. A discount received. Now for a discount received, we said that this entire transaction starts with occurrence of a credit what? Of a credit purchase. So of say shillings 40 million. And therefore we take which entries? If we make a credit purchase of 40 million. We debit purchases. We are debiting purchases, recognizing an expense called purchases. And this happens when you purchase, you debit purchases if you're purchasing inventory to resell or to use in further production. Are we together? So we are debiting purchases, and then we would have credited cash or bank. So we credit the mode that you have used to purchase, to pay. Either cash or what? Or bank. But in the event that you don't pay, it means that you're going to recognize an obligation to pay. Are we together? You have an obligation. Before you make these purchases, you have no obligation. Isn't it so? But the minute you make the purchases and they are given to you, now you have an obligation to pay if you have not yet paid. That's why for credit purchases, we debit purchases, and then we credit our trade what? The obligation is represented by trade payables. Are we together? Is represented by trade payables. Now, upon payment, assuming that we hit or we met the terms of payment, we are going to be given a 5% discount, cash discount upon payment. Even if they don't say it, but if it is a discount upon payment, then it will be a cash what? It will be a cash discount. All right. The minute we pay, in our books we had an obligation to pay of 40, not so? Now that we are paying, even if we are paying something less, we are paying it in full. So meaning that obligation has to disappear from our books. Are we together? So to make it disappear, we have to reverse that entry a bit. Not so? At credited payables, now we have to reverse it to remove those payables by so upon payment, we shall debit our trade what? Our trade payables with 40 million. Reason is we included it, we recognized it at 40. If you're to de-recognize it, you have to de-recognize it at the amount it was seated in your books of accounts. Are we together? So we debit it at 40. And then we are going to recognize the means that we have used to pay it off. Yeah? Be it cash or together. So that is an asset and it is reducing. So we credit our cash or what? Cash or bank account, depending on what you use. But how much are you actually going to pay? You're going to pay 95%, not so? Isn't it? Which is how much? 30? It is 38. Eh? So we are paying 38 million. The balance of 1 million. The balance of 1 million. You had a liability of 40, but you have ended up actually settling it with 38. Are we together? So meaning that causes or creates an income. Are we together? Because the reduction in a liability brings an income. Are we together, guys? Okay. That is from the conceptual framework perspective, but you may also choose to say that we have paid, we have received a discount received is an income. You just understand it like that. But trying to link it with the conceptual framework is better. So since incomes increased by what? We are recognizing an income, not so? So we have to credit the discount of what? Of how much? Of 2 million. And we are saying that our total credits are 40 million and our total debits are 40 million. Double entry. It doesn't matter how many credits you have, how many debits you have. For as long as the total debits are equal to the total what? The total credits, double entry is complete. All right. That's where we were last time. So meaning, on our list of expenses, we have added a discount allowed. Among expenses that we already knew, add discount allowed. And among incomes that you already knew, add discount what? Discount received. Okay. So today we are going to look at returns. returns. Now, this is some other area that is quite inevitable in most of the businesses, returns, returning back goods because of various reasons. Reasons can be very many. Maybe you have delivered more than we actually asked for. You have given us things that are not meeting the quality that we actually specified in the first place. We asked for Dell computers. You have given us Fujitsu computers. You know, such stuff. So we can always return back what we actually didn't ask for, or what didn't meet our specifications in our purchase order. So for returns, still the same way. Those returns can either be returns inwards or returns what? Outwards. Now, if it is a return inward, then it means that what happened in the first place before that return came into place. If it is a return inward, meaning there was a sale in the first place, isn't it so? And if it is a return outward, then there was a what? There was a purchase in the first place. So since this comes as a result of a sale, it will be so much affecting our trade what? Our trade receivables, isn't it so? Isn't it? It is you that have told me that returns inwards, they happen after a sale has happened, isn't it so? So meaning if a return has happened, it is going to affect your trade what? Your trade receivables, isn't it? Is on what? Returns inwards. Is it on purchases or on sales? If we sell, we take things out, right? Now, when they return it, if they return those goods or part of them, then they are returning into our business. Isn't it so? So returns inwards are as a result of a sale that we made previously. Returns outwards, we purchase some goods and we receive them, and then we take some of them back or all of them. Now those ones will be outward because those goods are moving out of our business. Okay, yes, please. So if you take goods on cash, do you even have a right to return? Eh? It may depend, but most of the times if you take cash, you don't even have a right to return. But what we normally look at here is business in an accrual perspective, okay? That you have sold, okay? And then you have to send an invoice to that person to pay you. Are we together? Before they actually even pay you, they returned back some goods. What you're going to send in the aftermath has to be less than that. That's why we are relating it so much to trade what? Trade receivables and payables in an accrual perspective. Okay. Returns outwards, they relate to trade what? Trade payables, isn't it so? Because they are from purchases. So meaning they will affect trade payables. And the effect that each of them will have will be that they will reduce them, isn't it? Isn't it so, guys? Do I have people following or people are in the weekend mood? More
We
so
are there.
the online team is so silent.
We are there, Jertoli.
Yeah.
We are following, sir.
Okay. So I want to start with a return inward. Returns inwards. Please, and please, these double entries, these entries that I'm giving you are very important. I want us to understand them because where we are going, we shall meet such transactions and we shall not have that much of time to talk about them a lot and a lot. It needs when we know these double entries in the first place. Okay, returns inwards. So, for them to come, before they actually came, there was an occurrence of a sale. Are we together? So there was an occurrence of a sale. Let's say a credit sale. Now, say of shillings, 10 million. And our double entry then was when the credit sale occurred, our double entry then was we debited trade receivables with 10 million. And then we credited the sales account with 10 million. This double entry should at least be on the tips of our fingers by now. Double entries of credit sales, credit purchases, cash purchases. Those ones, they should be on our fingertips. Okay, so we had a credit sale that happened, and we recognized the right to receive, which is a trade receivable of 10 million, and we recognized the sale. Are we together? Okay. After doing that, now a few days or a day after, a customer returns back some of the what? Some of the goods. So a customer returned some goods worth shillings 1.5 million. Yeah. The customer returned goods worth 1.5 million. And you acknowledged it, you even gave a customer a credit note. You gave a customer a credit note. Are we together, guys? Question is, what happens in our books of accounts? What happens in our books of accounts?
I think we credit trade receivables with that 1.5 million.
We credit trade receivables with the 1.5 million. And where will the other double entry go?
We debit sales by that much.
We debit sales.
Yes.
Someone else is saying, I'm getting ideas. Trade receivables of 1.5 million. Did someone say Casio Bank? Yeah, I heard someone saying Casio Bank. We are going to analyze each. We credit trade receivables with what? With 10 million. We debit the sales account. Oh. We debit the sales account. With how much? With 8.5. 1.5. Okay, 8.5. Double entry is not complete. We still have another debit. Debit sales returns with 1.5. Oh. I like what I see. Yes. We credit returns inwards. 1.5. And we debit sales account with 8.5. Meaning I still have a credit. Double entry is not yet complete. It must be equal, isn't it? Would you wish to change anything before we continue? Because
I think yes. After crediting trade receivables with 1.5, we debit returns inwards with the same amount.
After crediting, wait, I write it. Trade receivables with 1.5, we debit.
Yeah, return is inwards with that very amount.
That very amount. Do we still have double entries? This is going to be the last double entry. Because out of all these, there is one that is correct or there is none. Yes. Credit trade receivables with how much? I'm hearing whispers. The whispers are now changing your mind. Don't. Yes? 8.5. Credit returns inwards with 1.5 and debit sales 10. Okay, guys, this is enough. Thank you very much. You have given me quite some interesting double entries. Let me go back to where we started from. And I'm going to explain the meaning of each double entry in verbal terms so that even people mark themselves. Isn't it so? I don't have to say that it is wrong or it is correct, but I'll explain it in double entry language. Someone said debit inventory 1.5 credit. Okay, we have added that one. I think we shall even start with it. Okay, no, it has come last. It is okay, we shall end with you. We shall end with TA. Okay, we said there happened a credit sale. And that credit sale, because we didn't receive cash, we recognized our sales and we recognized the right to receive in the future. Okay? Before we even received, a customer returned goods worth 1.5. Okay? Goods worth 1.5. We had sold to him those goods. He has returned them. Their worthiness is 1.5 million. Okay? 1.5 million to us. And we have acknowledged, we have given him a credit what? A credit note, meaning we have stamped, it is okay, we have acknowledged it. The first double entry. Someone said that we are debiting sales and we are crediting trade receivables with 1.5. So this person said that our sales have actually reduced, yeah, because of the returns that we have made, okay? And Also, our trade receivables have reduced because of the return that was made. Okay? Our sales have reduced. We had recognized sales of 10 million. Because of the return, our sales are reducing. That's what that person is saying. We recognize the sales and recognize trade receivables of 10. Because of the return, he's saying that our sales are going to reduce and our trade receivables reduce by the same amount. Make sense out of it. Does it make sense? To the majority, it makes sense. And to the rest, it doesn't make sense. Why isn't it making sense? We sold them on credit. Yes. Mm. Mm-hmm. There's no way we are going to touch ourselves. Mm-hmm. There's no way we are going to touch ourselves before receiving the cash. So if we receive the cash, do we touch them? By what? The customer has not yet paid, and that is not an assumption. That is the correct thing. The customer has not yet paid. Will not be touched.
That transaction is the return will only affect the receivable.
Okay, someone is saying here that we cannot touch sales simply because we have not yet received the cash. My question to her was, what if we receive the cash? Do we touch the sales? Is the crowd agreeing with that? We shall see about it. What is your reason for this transaction not making sense?
But sales are both credit and cash. They can also be cash and credit.
Yeah, that is very correct. Sales can be credit and cash. I don't know in what perspective you're bringing this argument. Guys, be patient with us. We are trying to pick learning points from this entire double entries that we are having here. And this one in particular is going to raise a lot of points, I'm sure, than the rest, in my opinion, and maybe some other one that I will see later. You are saying? Is out of what? Someone is saying sales are supposed to increase on return, not reduce. Sharon is saying that sales, when they return goods, sales are supposed to increase. I think the crowd has disagreed with that. So do I. All right, guys. I think I agreed with some people that we are saying that sales we are not supposed to be touched. Okay? But their reason of not touching sales, I disagree with it. Number one, because we have to make sure that when we are preparing our financial statements, they faithfully represent the transactions that happened. If you reduce sales in the ledgers, then it means that in your financial statements, your sales will be less. And the sales that you will take in your financial statements will not be a true picture of the actual sales that were made. The sales that were made in this particular transaction are 10 million. Are we together? The sales are 10 what? Are 10 million. Under no circumstances can we say that we have reduced the sales. The sale happened, we recognized it. What happened afterwards is not changing our sales. But what does it change? We shall see later. This double entry was so close to correct the first one here. It was so close. And I really appreciate the person who gave it to us because it is really so close. Trade receivables, yes, they will reduce because if someone returns goods to us and we acknowledge that, please, your returns are acknowledged, then it means that we cannot demand them 10 million that we are demanding them in the first place. We shall demand them less. Are we together? So meaning their account has to be reduced by the amount of goods that they have brought back. Are we together? So if we had recognized a right to receive 10 million, that right to receive 10 million has been reduced by the amount of goods returned. Are we together? And that's the reason as to why we are crediting trade receivables. I hope that is okay. So do we agree that all other double entries that don't have credit trade receivables, I don't want to say they are wrong, but they are not a true representative of this transaction. Isn't it so? Okay, let's go to the second one. The second one is saying debit cash, credit trade receivables. Because of the return, our trade receivables have reduced by 1.5. That is okay. But as they were returning, they actually gave us money. Okay? As the customer was returning goods, the customer also gave us money of 1.5 million.
It was showed on credit.
Okay? So it is not money that we received, but the goods are the ones that were worth. Okay? So that one is so wrong. Okay. Then number two, they are saying that trade receivables with 10 million. Now, because we have received a return of 1.5, the entire amount that we are demanding them, we are writing it off. Are we together? We had the right to receive 10 million, and they have brought back goods worth 1.5, and for us, we say that we no longer have a right to receive. So, does the return of 1.5 write off the 10 million? In actual sense, the return of 1.5 would only write off 1.5 from what we demand. Are we together? Not 10 million. And debiting sales with 1.5, it means that you're reducing your sales with 1.5, and we agreed that you cannot touch our sales. That will be unfaithful representation. Oh, yeah, debiting sales with 8.5. No, it is not a true reflection. And debiting sales returns. Someone is bringing in some aspect here. Debiting sales returns. We are debiting sales returns of 1.5. Meanwhile, I agree with this. With only this part of the transaction, I don't agree with these ones. Okay? That we are reducing trade receivables 10 million. We don't agree with this, but we are going to see where we are going. And someone is saying that we are debiting sales 8.5, returns inwards 1.5, double entry is not complete even. Okay? Debit returns inwards, credit trade receivables. Let's assess this one. This one is saying that because they returned in goods, so what I do is that my trade receivables are going to reduce. My right to receive is reducing. Are we together? I was expecting 10, so I'll reduce 1.5 from that 10. Are we together? Then they are saying that, then I will have an account, a separate account called returns inwards. Are we together? And I will debit it with 1.5 million. Now, this is a true reflection of this entire transaction. Are we together? Ideally, under normal circumstances, this is okay. Agree. Okay, we even had someone who agreed in the first place. Under normal circumstances, guys, when they return back goods to us, we have to write down the receivable. Not so? And under normal circumstances, we had to write down our sales. Are we together? But because we cannot reduce our sales in the ledgers, that will be a true misrepresentation. Are we together? We come up with a separate account called returns inwards or sales returns. Are we together? Now, that account, at the point of preparing our financial statements, we shall show it clearly that it is going to reduce our sales, but after representing the true picture of sales. Are we together, guys? So that is why this one is passing the test. And of course, this one is not passing the test. Okay? All right, I think that is okay. This one is not passing. That is okay. If goods are returned inwards, Then understand one thing, we have to create a returns inwards account. We have to create a returns inwards account. Are we together? I just don't want to call it an expense account, but take it in that perspective. Are we together? Take it in that what? In that perspective. But that particular expense will offset our returns, our sales, specifically when we are preparing our financial statements. And the reason as to why I did not agree with someone that debited sales, even if eventually that will be the actual effect. Are we together? Eventually that will be the effect, but we don't want you to show that effect in the ledgers. Because if you show them in the ledgers, the figure you're going to take in our financial statements will be less. Are we together? Let me use this same example to explain it further. Assuming this was the only transaction that we had in a year. Are we together? Two people are going to report two amounts. Or they are going to report in two ways. The first person is going to report in their statement of profit or loss that, please, my shareholders, I have made sales of 8.5. Are we together? Yet another person will report that, my shareholders, I have made sales of 10, but some of them were returned, so I'm lessing them. Which one represents better the affairs of the transaction? Should I repeat? Let me repeat. If this was the only transaction that happened in the year, and in this particular case, we are debating on only two double entries. The first set of double entries is someone who said that we are going to debit sales. Are we together? With how much? With 1.5. And credit, trade what? Trade receivables with 1.5. And another set is someone who actually said that we are going to debit what? Returns what? Inwards with 1.5. And credit, trade what? At this stage, we know who is right, not so? We know the correct double entry, do we? Which one is the correct double entry? In which color? Okay, people are here seeing blue. Guys online, which one is the correct double entry?
Blue.
Okay, all of us are seeing blue. It is okay. So the correct double entry is the one in blue. Okay, the one in red like is wrong. Are we together? But I'm now taking an assumption to make sure that I explain it better. Maybe we can understand it that way. If this was the only transaction that happened during the year, and now we are reporting to our shareholders, this person in red would say that in the year I have made sales of how much? They credited sales with 10 million, and now they are debiting it with 1.5. That opposite nature represents a minus. Are we together? That opposite nature represents a what? A minus. If you credited 10 and you're debiting 1.5, it means that get 1.5 less it from what? From 10. So that person says that I have made sales of how much? Of 8 point what?
8.5.
0.5 million. Are we together? And now this person here, this side, for them, they are saying that the debit is not sales. So in the end, my sales ledger will be 10 what? Will be 10 million, isn't it so? But then they say, I recognized a returns inwards account. Are we together? And this returns inwards account is going to less my what? My sales. Are we together? So this is what they report. This is what they report. And the other person, this is what they report. Which one represents the affairs of the transaction perfectly? People here saying blue. People online, what are they saying?
Blue one.
The blue one represents fairly. And why does it represent fairly? Because it is telling the shareholder how much the actual sales were, not so? And then it communicates that, however, part of those sales were what? Were returned. Are we together? So meaning the shareholders will also get to know that in this nature of business that we are in, some of the goods can even be what? Can even be returned. But the other person who says sales of 8.5, I will not know that even a return ever what? Ever happened in the business. Are we together? So that's why whenever a return is made, if it is inward, we have to create a return inward account. Are we together? And then we affect the receivable, because as a result of giving the receivable a credit note, acknowledging the return, it means that what we are expecting from them has to be reduced by the amount on that credit note. Are we together? Is it okay? Our online team, are we fine?
Yes.
Okay. Then let's go to a purchases return. A purchases return or a return outward. So in the first place, before the return, there was occurrence of a credit what? Of a credit purchase. Say of 5 million. And then the double entry was debit purchases and then credit trade what? Payables. Recognize an obligation to pay. Okay. Then we returned some goods back. We returned some goods back worth 0.8 million to the supplier. The supplier. I'm sure this is supposed to be very easy. This is supposed to be very easy.
We debit payables.
We debit trade payables
by 0.8 million.
By 0.8 million.
And credit returns outwards by the same amount.
And credit returns outwards by the same amount. I think this is okay. It is easy from the previous explanation. Is this okay? Okay. All right, guys. Please don't factor in inventory. That makes me even remember. Someone in the previous transaction debited inventory. I'm sure the reason as to why they debited inventory is because returns inwards, they are returning goods, okay? And since they are returning goods, we are debiting inventory. It's like you're debiting an asset. Are we together? I would have like 2 explanations of that as to why it is not actually correct. Number one, when you were selling, it was selling price, not so. And you cannot debit inventory in a selling price, okay? Because inventory in the first place, it was on cost. So that makes it wrong in the first place. And then number 2, debiting inventory is like you're debiting an asset. Are we together? And that is never an asset. Okay. But most of these things, I think we shall understand them better after looking at international accounting standards too. Okay. Are we okay up to this place? Guys, are we okay? So if we are okay, discounts returns, we have those two ledgers. It's very important. We are going to see that today. The trade receivables ledger and the trade payables ledgers, they are very important ledgers. Very important. At a certain point in time, we shall even grow control accounts to manage those ledgers. Now, ability to manage those ledgers, you must know what affects those ledgers. Are we together? So far where we are, if we are to start with the ledger of trade receivables, and I ask a question, under what circumstances can trade receivables be affected, either upwards or downwards? What answers would you give me? Under what circumstances can trade receivables be affected, either upwards or downwards? At this level, we have three reasons. Number one, returns.
Discount.
And what does it do? Reduce, increase. Reduce it. And then number two, discount allowed. Not so? What does it do to trade receivables? Reduce, increase.
Increase.
One night.
Reduce.
Discounts allowed. What do they do to trade receivables? Increase, reduce.
Reduce.
Reduce. I thought that you guys wanted to start singing this song of Santana. Is it Santana? Have you heard of that song? Okay. Me, I like those statements in songs. I normally keep them in the head. Okay. Those are two, returns inwards and then discounts allowed. And both of them reduce. Are we together? So if my trade receivables have a debit balance, if I talk about returns inwards and discounts allowed, they have to be credited under normal circumstances and actually under all circumstances. Returns inwards, discounts allowed, they will cause my trade receivables accounts to be credited. Isn't it so? The third one, and it is the last. So far by now, we must be having three circumstances under which trade receivables are affected. Which ones in particular? Sales, which ones in particular? We have credit sales, perfect. The third circumstance under which our trade receivables can be affected is credit sales. And how does it affect trade receivables? Does it reduce or increase? It increases. Are we together? Meaning, whenever we sell more on credit, our trade receivables increase. For now, that's where we are. And that list is still ongoing. It is still ongoing. But I can also add a fourth one because by now we must know. The fourth one, the fourth circumstance under which trade receivables can be affected is what? We have talked about three: returns inwards, discounts allowed, and credit sales. The fourth one, and it is the most obvious one. Cash or bank? Cash or what? Meaning whenever we receive money from what? From them. Isn't it? Doesn't it affect trade receivables? Whenever we receive money from them, either in cash form or in what? In a bank form. Are we together? Sorry? By derecognizing them. So meaning that reduces our trade what? Our trade receivables. Guys, are we together? I repeat which one? Cash or bank. Okay, we said there are four circumstances. So far where we are, there are four circumstances under which our trade receivables can be affected. Are we together? And we are saying the first one and the most obvious one is when those receivables actually pay us. Are we together? So a cash or bank entry. And when they pay us, that transaction will reduce them. Isn't it so? So when we receive from trade receivables, trade receivables reduce. Are we together? look at trade receivables as a right to receive cash in the future. So if they pay you now, that right to receive has to reduce, isn't it so? Then number two, we said under a discount allowed. That if we give them a discount, we allow them a discount, that discount will cause them to reduce. Are we together? And then number three, we said under a return inwards. Are we together? That if they return some goods back to us, still the right to receive reduces, trade receivable reduces. And then number four, we are saying that in case of a credit sale, when we sell more to them on credit, that right to receive does what? It increases. Are we okay? Up to that point, okay. Then should I ask the same questions for the trade payable? I think they are the same answers close to, not so? The first one is what? For trade payables.
Credit purchases.
Credit purchases. When we purchase more on credit, the obligation to pay increases. Then number two, returns out. When we return some goods out, the obligation to pay reduces. Are we together? And then
discounts received.
Discounts received. When we receive a discount, the obligation to pay reduces. And then finally,
settlement of that debt.
When we settle the obligation. Perfect. So if we settle the obligation, write it off. It reduces the obligation. Now we shall be adding others going forward on that list. And why am I out of all ledgers that we have so far looked at? Why am I so much taken up by trade receivables and trade payables? They are our major bit of trading. Are we together? The reason as to why we are ordinarily operating trade payables and trade what? And trade receivables. Are we together? Those are called personal accounts, and personal accounts are very important. We are going to be looking at them today. All right. Let's look at the concepts, and then we go for a break. Then when we come back, we shall unleash our ledgers. I've been promising to look at this for quite some time. I think this is the right time for us to understand these concepts. Now, these concepts, some of which we actually looked at in our conceptual framework, they are additional regulatory, let me say authorities. It is an authority in terms of regulation that if we are to prepare and present our financial statements very well and prepare our financial records very well, we must have this in mind, okay? These concepts are very important, some of which we have actually even talked about. The business entity concept. Now, this business entity concept, as we are transacting and as we are recording financial transactions and business transactions, we have to make sure that we do not include personal transactions into business what? Business transactions. Are we together? The transactions of the owner relating to the owner are different from the transactions of the business. And this is one reason as to why whenever business resources were put to personal use, we could recognize a drawing. And whenever someone uses their own personal resources to do their own personal things, we ignore. Isn't it so? I think we have seen that very many times in the examples that we have been doing. The reason behind that is because of the business entity what? It's because of the business entity concepts. Are we together, guys? Second, going concern. This going concern, we even looked at it in our conceptual framework. And we said that this is a very big underlying assumption, very big underlying assumption of preparation of financial statements. So this says that if you are to prepare financial statements, then we have to make sure that the basis of preparation of those financial statements is going concern. And going concern, you're trying to record or to prepare your financial statements in a way that we are seeing that business to remain in existence for the foreseeable future. Are we together? So we are seeing the business to continue in operations for the foreseeable future. Are we together, guys? Now, these things, they are not so explicitly on the course outline, okay? But they are very important and they are examinable for your information. So that's why we bring them as additional, additional, because we need to know them. Some of them you will find in the book, others you won't. Just like most of the things. Okay. Money measurement or the monetary measurement. The transaction that we are recognizing has to be able to have monetary value. Are we together? It must have a monetary what? A monetary value. And I think you're seeing debit something amount, not so? Credit something amount. So if something doesn't have a monetary value, then it is not fit to be in our financial books of accounts. Are we together, guys? Are we okay? Periodicity. Periodicity. Whatever we are doing here, it has to end in reporting. It has to end in what? In reporting. By reporting, we mean that it has to end with financial statements. And those financial statements, we expect them at least every what? At least every year, at least annually. Okay? And I think if you're seeing them, they are just supplements to whatever we have been looking at. Okay? Like some bit of guidance. They are guiding you. When you're recording these transactions, they guide you. And when you're preparing the financial statements, these concepts keep guiding you. Materiality is based on the notion that if exclusion or inclusion of certain information from or in a certain piece of bigger information affects decision making, then it is material. If a certain piece of information is removed from the big set of information and it affects the decision that someone takes, then that information that has been removed is material. Are we together? So it advocates for making sure that we include, to start with, in our financial records, all information that is material. Are we together? Because exclusion of that information will affect decision what? Decision making. And after inclusion, you have to make sure that items that are material, you have to present them separately. Are we together? Because they are material, they need to be seen. Immaterial items, you may aggregate them with other materials, with other immaterial items. That is what we call materiality. But this comes so much at the point of preparation of financial what? Of financial statements. Even periodicity at the point of preparation of financial statements. Money measurement at the very book, the bookkeeping level or the bookkeeping stage. Going concern, financial statements level. This is essentially the concept from the bookkeeping what? From the bookkeeping level. And now prudence. This is one word that I will use very many times as I'm speaking. Prudence in accounting, what does it mean? Stroke this word prudence with the word conservatism. That's why they say that accountants are conservative. It is simply because of prudence. Now, prudence brings in some bit of caution. Okay? It brings in some bit of caution that you would not want to count on your eggs before they what? How do they say it? Is it the right saying? Don't count on your eggs before they hatch. Because enkoko, the hen, some things are better in Uganda. Because the hen has given birth to how many eggs? I don't know. Is it giving birth to eggs or it is laying? The hen has laid 10 eggs, and then for you start saying that, you start jubilating that I have 10 chicks. Is it the right time to start jubilating? Which page? This is a very strong question. Which page is this in the book? You try and check. 38, 37, 39. But I want to say, let me repeat it if I haven't said it. Most of these PowerPoints, you may find some things, most of the things in the book, but some things you won't find in the what? In the book. Okay, maybe at the financial accounting level, most of them are there. And when it comes to financial reporting, most of them are not there. Because this is one way of giving people value for what? In my perspective, okay, I want to first be selfish. They help me in the first place because when I'm teaching using this, I don't have to dictate for people to write notes. I simply project, talk about it, then I share. Isn't it so? It saves time for me in the first place if I'm to be selfish. And then number two, as I'm developing them, I include in other relevant things that are examinable, but not on the course outline, and certainly not in the book. Are we together? So they could have other things. So that's why I come up with them. But still, if you have it in the book, it is so much enough for you to pass. So if you don't have enough time to read, concentrate. Are we okay? But I strongly recommend that as you're reading, you also serve. Read as much as you can before the paper. Conservatism. Don't start counting that you have 10 chicks because your hen has laid 10 eggs. No. Wait for them to hatch. Then you start saying that I have chicks. Are we together? Now that is it. It calls for these two items should not be overstated. Assets and incomes, because they are so prone to overstate. They are so prone to overstatement. Before an income has been recognized, the transaction has been recognized, don't say that you have an income. You cannot say that I have an income when you're just expecting it, okay? You wait until you earn it. Until, I want to change that word, not receiving. You wait until you earn it. Perfect. Until you earn it, then you can say that I have an income. Before you earn it, don't say that you have an income. However much you have received it. Are we together? However much you have received it. If you have not earned it, don't say that I have an income. And the same applies to assets. You cannot say that I have an asset when you have not yet gotten it. It is like now someone saying that I have a car. Because they have 20 million at home, at any time they can go to a bond and they get a car. Are we together? If I have 20 million here and I can get a car anytime, should I say that I have a car? You don't have a car. Are we together? You can only say that you have a car when you get what? When you get a car. That is prudence. But always and always and always be cautious, very cautious, and try to incorporate as much as you can expenses and liabilities in your financial statements for as long as there is an obligation that you will pay. Are we together? And then number two, if you have incurred them, or if there is a high probability that you will incur them. I'm going to give two circumstances. The first circumstance, I have slept in someone's house for the month of January. I have not paid it. I'm going to recognize an expense. Guys, please mute. That is Shamira Nanjonju. I have slept in someone's house. I have to pay 500,000 for the month of January. January is done. I have not yet paid. So should I say that I haven't incurred an expense? You have an expense, not so? Just that you have not paid it. Are we together? And then now, transaction number 2, example number 2, is that I have a court case going on. Are we together? And as of today, when I'm preparing my financial statements, my lawyers are telling me that you have a 90% chance of losing this case. Are we together? You have a 90% chance of losing this case. And when you lose it, you will part with 20 million. Do I have an obligation and an expense, or I don't? Because that is actual prudence. That is only one person. The rest have not said anything, even including the online team. The first one was easy. The second one is, I have a court case that is running. Are we together? Today is my date when I'm supposed to communicate the affairs of my entity to my shareholders. Okay? And I asked for the proceeds of this case. My lawyer tells me, as of today, 31st of December, 2023, you have a 90% chance of losing the what? The case. And if you lose, you will part with 20 what? With 20 million. Do I have an expense and an obligation to pay in that transaction?
Not yet,
Not yet. Why not yet?
because you have
the
not yet lost.
Because the judgment hasn't been passed. Okay.
Yes.
And then, that's a very nice. Someone is asking, can't I provide for it? Now, have you ever heard people saying that you cannot answer a question with a question? They have just answered my question with a what? Now, that is a very nice answer to my question. Can't I provide for it? Is an answer, though in a question format. And it is a very good application of prudence. Are we together? That as for expenses and liabilities, don't wait for that liability to come. For as long as it is probable that you will incur or pay that expense, provide for it now. Are we together? Instead of waiting for it to hit you abruptly, you rather provide for it and you say that I will part with 20 million. Are we together? So I have an expense of 20 million and I have a liability of 20 what? Of 20 million. If you win, it is okay. Are we together? If you win, it is okay. You have not affected anything in accounts. Just reverse what you did. Are we together? Than you saying that I have an income of 10, yet you have not yet gotten it. That is very misleading than a person who provides for an expense. Are we together? We call that what? We call that prudence. And then accrual. Accrual, we have been talking about this very many times. We don't have to wait for a transaction to so we don't have to wait for cash to exchange hands for us to say that a transaction has occurred. Are we together? Actually, when I'm explaining prudence, I want to merge it with accrual. I want to merge it with matching. Are we together? Those three: prudence, accrual, and matching. I normally want to explain them together. And if you're to look at them closely, they are interrelated. Accrual, don't wait for cash. Are we together? To exchange hands. If you have made a sale, don't wait until they give you money to say that I have made a sale, so I credit my sales. No. Credit your sales there, and then when the sale is complete, okay? And instead of the cash that you have not received, recognize a right to what? To receive, okay? The same for an expense. Are we together? And that's what we should be looking at after this topic of ledgers, accruals and prepayments. There will be so much in accrual and matching concept. Now matching, which is down here, let me explain it first because it is in relation with what we have seen so far. matching says that the incomes that you have earned. Now, when I'm explaining this, none of these words that I'm going to use has been chosen at random. Are we together? I am intending whatever I'm saying. And for you to better understand it, please take everything that I'm saying, comprehend and interpret it, then disseminate the information to yourself. So does that mean in that case, we include 20 million payables? Very right, yes. Include it in your payables, include it in your expenses to reduce your what? To reduce your incomes. Are we together? So meaning in such a case, such a person will be reporting less profits. Are we together? And they will be reporting high liabilities. To prudence, that is okay. You rather report less profits than overstating profits, because that will be giving hope to people, and it is not right to give hope to people and in the end you disappoint them, isn't it? Imagine waking up and your account has been credited by 20 million without you knowing. Your account in the bank sends you a message, or only to check, you find my account balance is 24. I had 4, now I have 24. Are we together? And then after giving you a lot of hope and you start budgeting, okay, someone is demanding me. The following day you find the 20 has been reversed. Is that person better than someone who actually goes to your account where there is 4 million and you find tomorrow there is 1 million? And then you start, how do they call questions in English? You start gearing yourself, you gear yourself, you go to the bank, you abuse everyone and whatever. And then later you settle for it, you say, my money has gone, it has gone. I have 1 million. And then the following day you find your 4 million back. Which position is better? The second one is a better position, not so. So that is prudence. Matching. Now, the incomes that you have earned in a certain period and the expenses that you have incurred to earn those incomes must all be reported in the same reporting period. Let me repeat. The incomes that have earned in a period and the expenses that have incurred to earn those incomes must be reported in the same period. Are we together? None has to be outside that period. That is the brief of matching. Are we together? So if I have ended my period at 31st of December 2023, and there is some rent of December that I have not paid, that rent of December was incurred as a result of earning revenues or incomes in that period. So hence I cannot bring that expense of rent for December in January. Are we together? However much it is in January that I'm going to actually pay for it. Mind blowing, but it's okay. Our next topic is that. Okay? Duality concept. We saw that that's what we started. We saw of recent. This is the mother of double what? Of double entry. That every transaction has a dual effect. We saw that. Substance over form. Very important concept. Substance over form. Now, substance is like the economic reality, and form is like the legal reality. Okay? Substance is economic reality. Form is legal what? Is legal reality. So what this says is that for any transaction, you make sure that you have to communicate the economic reality. Accounting wants the economic what? The economic reality, not the legal reality, not the legal form. And I will give an example. When we're looking at our conceptual framework, we said that for us to recognize an asset, it is not all about ownership. It's about control. Isn't it so? So are there circumstances where control can be different from ownership? Or no? Are there circumstances where control can differ from ownership? You own something, but you don't control it. Or you control something, but you don't own it. Very important. Those circumstances are very many. Are we together? For example, leasing. For example, what? Leasing. You lease someone's vehicle, you will control it. Are we together? Then they are the owners, but it is you controlling. You're controlling the economic benefits. All of the economic benefits are coming to you, but you don't own that car. Are we together? Accounting says that you're the owner. Are we together? It doesn't say that it has given the car to you, but it says as
Ipabangkay na umuliro. Thank you for cooking, man.
Online class, are you guys hearing anything or it's just me?
Oh. Did what? Lero lwakumeka yakoma ku Monday ng'ogenze. Teri mwana ndi wano nagulayo akabokisi. Nja kukagira ng'omwaka guweddeko.
All right, welcome back from the break. So we are supposed to go to ledger, which we introduced a bit last time, but today we are going to be looking at it in some great bit of detail. All right, so in these ledgers, this is where the double entries of transactions are made, meaning that these ledgers, we shall summarize the increases and decreases of each element of financial statements. So we shall be coming up with a ledger for each element of financial statements. So that these elements of financial statements are 5: assets, liabilities, incomes, expenses, then equity and its components, capital and reserves. So upon occurrence of a certain transaction, these entries shall be taken to the ledgers after our books of original entry or books of prime entry. And what we call a ledger, it can be divided into two. Okay, so ledgers. The ledger can be divided into two. Number one, we have a general ledger, and then we have subsidiary ledgers. A general ledger or subsidiary ledgers. Those are two types that we are going to be seeing. But before we even go into the overall description and definition of what a general ledger is and what subsidiary ledgers is, we have to know that a ledger is like an account, like we said last time, that we shall be drawing it in form of a capital what? In form of a capital T. So it is an account. That's why for each element, for each type of element, if we are to debit cash, we say cash account. So meaning that entry shall be taken to an account that has a title called cash. Are we together? If we debit cash, meaning you go to an account that has a title called what? That has a title called cash, and you record that particular entry on the right-hand side. Now, what we call an account is like a unit of double entry, meaning we use accounts to actually show the effects of double entry in terms of increase and increases. So these accounts can either be personal or impersonal accounts. There are two types of accounts. The account can be relating to personal items or impersonal items. So what we call a personal account, it relates to an account that relates to receivables, payables, capital, because capital is for the owners, yeah, the claims of the owners. So examples of such personal accounts are a capital account, debtors, creditors. The key thing is that it will relate to a name of a business, a person, or an entity. Yeah, that is what we call a personal account. And then we have impersonal accounts, which impersonal accounts can either be real accounts or they can be nominal, accounts. Are we together? If they are real accounts, then they will relate to tangible items. And if they are nominal, then they will relate to intangible items. So it will be a real account, relates to like a building, so buildings account, are we together? Motor vehicle account, inventory account, things that we can touch and feel that have physical substance. Are we together? And then if it is a nominal account, then it will be that account that doesn't have physical substance. Rent. Someone says rent, I don't touch rent, not so. So expenses accounts are nominal accounts because you cannot touch an expense. Are we together? You can't touch it. But tangible assets, they are real accounts, but we also have some intangible assets. Are we together? So intangible assets are examples under nominal accounts. So when we talk about accounts, take it to be that T account that we shall be drawing. Are we together? And we shall use it to show the double entries. So meaning it is the same T account that we shall be calling a ledger. Are we together? It's the same T account that we shall be.
You go back. You go and be with baby sister.
So that ledger there that we are trying to talk about here as a T account, we have seen, I think, some of its properties. We say that number one, that T account must have a title, isn't it? It must have a title of an account. For example, the title. For example, this title could be that the account is relating to a bank what? A bank account. Are we together? Or cash account, or buildings account, whatever. Are we together? And then, being that it is double entry, we must show that we have a debit and a what? Let's show that we have a debit and a credit. Are we together, guys? And then it must show the currency and the level of precision. Just to show the currency and the level of precision. You can either show it up here, that shillings may be thousands. Are we together? Or if you don't show it up there, then you may need to show it on each column where you're going to put amounts. Are we together? Each column where amounts are going to be. Are we together? But if you're to avoid this, then you can put the currency and the level of precision above the account next to the title, and that will be finished. Are we together? But never dare to make a mistake to draw a T account representative of a transaction that is in millions, and you write thousands here and you don't show that you have precise some zeros up. That is a grave error, and we shouldn't be making it because it is common. When we are in accounting, it is so common to cut off zeros, isn't it so? That if you're dealing in figures of millions, billions, someone can choose to precise and they knock off all the zeros, or maybe 6 zeros or 3 zeros. But now it is also a common practice for people to forget to show that they have actually knocked off zeros. Now, those two things, that can mean completely something different. Are we together? So we have to make sure that we show. So that is it. We said we have a debit, we have a credit. Under no circumstances can these interchange. This can never happen. Are we together? It can never happen. It can never be the case. So it will always and always be debit and what? Yeah, it will always be debit and credit. Are we okay? And then we said that beneath the account, this account here on both sides, it is divided into columns that we shall not be showing all the time. Are we together? But we must know that each account, at least it must show a date, account title, and then the what? And then the
second.
Guys, mute, please. Let's mute. Okay. So date, account title, amount on both sides. Okay. It is not a must to write date, account title, and then amount. It's not a must. Okay. But as you're filling in, as you're populating the ledger, that's how it should move in that order. So if this is available in any ledger, then it is good enough. Okay. This is how it should look like for any element. If it is an asset element, liability element, incomes, expenses, this is the list that particular ledger will have. And we are saying that that ledger, or what we call a ledger, it can either be a general ledger or a subsidiary ledger. Now, what we call a general ledger, it is a combination of very many different ledgers representing all elements of financial statements. Are we together? So meaning In a general ledger, we can have a cash ledger. In a general ledger, we can have a bank ledger. In a general ledger, we can have a buildings ledger. Are we together? We can have a sales ledger. We can have a purchases ledger. We can have rent. We can have electricity. We can have, are we together? So if all of them are combined for an entity for a particular period, then we form what we call a general ledger. Do we get marks for proper labeling? Now what do you want? You don't want to label. And please, you also help us unmute, Shamir. Oh my God. The questions are very interesting here. Okay, do we get marks for proper labeling? Because if you don't label, no one will know what you're doing, isn't it so? If you don't put that I'm dealing with a bank account, no one will know. Are we together? That is it. And if you don't show that you're in shillings, then someone can say you're dealing in USD. Are we together? Then thousands, you have to show maybe you have knocked off thousands or millions, or you haven't. If you haven't, it is okay. You don't have to put all your zeros in there. But you see, when the figures are too huge and you have a space that is too little, too small, then you have to precise. I think everything is necessary. Whatever we have put is very what? Is very necessary. And it will earn you marks, but not separate marks that you have put a title, a mark. You have put UGX, a mark. A debit, a mark. No. They cannot give marks Ezekiel on any ways. Marks of what? You help me translate that one in English. So what we call a general ledger, it includes, for example, number one, if you have, and this list is endless. Are we together? All ledgers of transactions of an entity in a certain period, grossed up together, they form what we call a general. They form what we call a general ledger. For example, which accounts? Which ledgers can we have in a general ledger? Maybe we have a cash account. So there will be accounts there, then the other one. Yeah, rent account can be in a general ledger. Okay, expenses, you are grossing up all expenses, okay? All expenses accounts. Then meaning I can also say all incomes what? Income accounts. And all asset accounts. Are we together? So all those accounts, meaning including you can have the data as what? Or trade what? Trade receivables accounts. And then trade what? Payables accounts. Trade payables accounts. And very many other what? And very many other accounts. Now, how is the general ledger different from what we call subsidiary ledgers? Subsidiary ledgers, they look at only two ledgers, debtors and creditors, or trade payables and trade what? And trade receivables. So subsidiary ledgers can be two. We have the trade receivable subsidiary ledger. And then we have a trade payables subsidiary ledger. Trade receivables, and then the trade payables subsidiary ledger. Are we together, guys? Now, what is a trade receivable or trade payable subsidiary ledger? Because we saw that even in the general ledger, we have a trade receivables ledger, and we also have a trade payables what? Ledger. Now, what we call a subsidiary ledger. A subsidiary ledger, if someone says that purchased inventory worth 2 million from KK Limited, Are we together? Purchased inventory of 2 million from KK Limited on credit. Yeah? Purchased inventory of what? Of 2 million from KK on credit. What would be the double entry there? Purchased inventory. We are debiting the purchases account with 2 million. And then we are crediting the trade payables account. Are we together? With 2 million. Now, what we call a general ledger, the trade payables in the general ledger is the trade payables ledger that is used to record all transactions relating to trade payables. But the trade payables subsidiary ledger records for only that particular payable. Are we together? If it is KK, it will only record transactions relating to KK. Do we get a difference between a subsidiary ledger and a general ledger? General ledger, all trade payables. Are we together? Whether it is KK or it is ABC Limited or whatever, for as long as they are trade payables in the general ledger, of trade payables. But if we are in the subsidiary ledgers, the trade payables subsidiary ledgers, meaning we shall come up with an account for KK, we come up with another account for ABC. Are we together? We come up with another account. So that one account, if it is for KK, we shall record only and only transactions that relate to KK. And those two accounts, they are reconciliation accounts. The subsidiary ledgers can be used to reconcile the general what? The general ledger of the trade payables. Because if what we do in the general ledgers, we also do the same thing in subsidiary ledgers. Then at the end, the balance in the general ledger should be equal to the balance of the totals in the subsidiary ledgers. Isn't it so? Isn't it? So we can use those two to reconcile one another. The same happens for the trade receivables subsidiary ledgers. Oh, sorry. I think I lost the online team. Where did we stop? Guys online, where did I stop?
It's
On a
just
general ledger.
subsidiary ledgers of making KK and what you're giving examples.
I was giving an example of KK and ABC. So we say a general ledger, the trade payables in the general ledger is the trade payables ledger where all payables, irrespective of whether it is A Limited or B Limited or KK Limited or ABC Limited, all of them will go to the trade payables ledger in the general ledger. But the subsidiary ledgers, they look at each independent what? Trade payable. That is what we were saying. So you may need to come up with KK's ledger only, and then ABC's ledger only. That is what we call a subsidiary ledger. So for KK, you only record transactions relating to KK, and then for ABC, you only record transactions relating to ABC. And then we said that after, in the end, you can use these subsidiary ledgers to reconcile with your journal ledger. Because whatever you do and you take in the general ledger, you have to also pass it in the subsidiary ledgers. So in the end, it is very easy for you to reconcile because the amount that's supposed to be in your general ledger of payables has to be equal to the total balances in their subsidiary ledgers. And hence someone will be able to know that if I have payables of 100 million, then 20 million relates to KK, 15 relates to ABC. Are we together? At the end of any period. Now, that can easily be done if you have what we call subsidiary ledgers. So that's why we strike a difference between general ledgers and then the subsidiary ledgers. And subsidiary only relates to payables and receivables. Are we together? Payables, receivables, payables, receivables. That's why we shall have our subsidiary ledgers. But for purposes of coming up with our trial balance will be picked from our general ledger. Are we together? We shall pick the trial balance from the general ledger. Okay. So after that, come up with what we call the trial balance Right. Okay, so we're saying that after after coming up with your ledgers, meaning the ledgers of different accounts, assets accounts, liabilities, incomes, expenses, then you have to balance off those ledgers. Balance off the ledgers. And after balancing off the ledgers, then in the process of balancing off, which we saw a bit last time, not so, you have to ascertain a balance carried down or a balance brought what? Yes, balance carried down and the balance brought down. Now you use those balances to extract what you call a trial balance. What we call a trial balance is simply a list of balances from different accounts. Okay? Remember, when you are drawing your general ledger, you came up with a cash account, bank account, salaries account, rent account, trade payables account, trade receivables account. Are we together? At the end of the period, you're going to balance them off. Okay? After balancing them off, you're going to get balances. Those balances, they are the ones that you're going to shift and you take them to the trial balance. So our trial balance looks like this. Our trial balance. Now this is theoretical, but that will be, I think, on Wednesday. That's when we shall do a comprehensive number with ledgers and the trial what? And the trial balance. But let me use this chance to talk about them now, so that when we get to that stage, we shall just be doing. Isn't it so? So the trial balance, for example, if the company we are looking at is ABC, then the heading will be ABC's trial balance as at maybe 31st of December, 2023. Now, a trial balance, we use the phrasing as at because it is showing balances. Are we together? It shows balances, and balances, it is a balance as at a certain date. Are we together? So when we are extracting a trial balance, we say that ABC's trial balance as at. Now, before we say it, that when you are entering transactions into the ledgers, you're posting them. Are we together? When you're moving from the ledgers to the trial balance, you're extracting the trial balance. Are we together? So you will have the account title, no date. Are we together? You'll have the account title, then you have the amount to debit, and then the amount to what? To credit, depending on whether you precised your ledgers or you wish to precise your trial balance. Now, this is how the trial balance will look like. Are we together? So meaning, if in your general ledger, you had an account called cash, then, and you balanced off that account called cash and you got a balance of maybe 2 million. Then here you'll come and you say, I have a cash what? A cash account, and its balance is 2 what? Are we together? Its balance is 2 million. Are we together, guys? This is what we are trying to talk about. If in your ledger you have an account called trade receivables, and after balancing off your trade receivables, you got a balance of 20 million. Then here you'll come and say that my trade receivables, they had a balance of 20 million. But in order for you to get this, you must pick it from the ledgers. And in order for you to draw your ledgers, you must not double entry. Are we together? And from double entry is for a particular transaction. So meaning we shall be given transactions, a series of transactions. From that series of transactions, we shall be ascertaining their double entry. Are we together? After ascertaining their double entry, we shall pass the double entry into the various ledgers. If the double entry is debit cash, credit sales, then meaning we shall have a sales ledger and we have a cash what? A cash ledger. Are we together? We debit cash ledger, we credit sales ledger, following the rules of double entry. If on a certain date later on, we also get another sale, which is maybe on credit, and we debit receivables, we credit cash. Then, sorry, we debit receivables, we credit sale. Debit receivables, credit sales. Then we don't have to draw the sales account again because we already have it. Are we together? Shall just pass that entry there. And then the other entry, we take it to the receivables what? To the receivables ledger. That's how we shall be doing it. At the end of all the transactions, we shall have very many ledgers, isn't it? Because you will be creating those ledgers as and when the transaction permits or requires. Are we together? Now, all those ledgers after all the transactions coupled together, they are what we call the general ledger. Are we together? After getting them, balance them off. After balancing them off, take the balances to the trial balance. Are we together? Depending on the side where the balance is. Are we together? So, but we shall be seeing that concept when we reach there. Which side and where should we take in the trial balance? In the end, after bringing all those balances, your trial balance must what? It must balance. The total amounts on the debit must be equal to the total amounts on the credit, which will always not be the case to everyone. Isn't it so? Yes. And because it will not always be the case to everyone, we have what we call errors and suspense accounts. Are we together? Errors and what? And suspense accounts. So that will be a topic that we shall look at after. Are we together? Yes. The main reason of preparing the trial balance is to prepare financial statements. That is the major reason. After having your trial balance, then preparing financial statements, we pick the information from the trial balance. Are we together? But before we prepare financial statements, we have to first of all check if the trial balance has information that is what? That is correct, because its balancing to start with is not a reflection of correctness, that you have everything is okay. People's trial balances will balance, yet what they have put there is what? It's wrong, but that will be a topic for another day. Today, we are stopping here. Next class, we shall be doing a comprehensive number. So, I'm not going to use the illustrations that we have already. However much they can help us to do what we want to do now. I'm going to get a complete set of an illustration different from what we have seen. And then we shall be, and I think I will pick it from the question papers, the previous papers. That's what we shall use. And we use it to extract to draw up ledgers and extract the trial and extract the trial balance. That will be in our next class. Not an easy thing. So we may need to come prepared a bit. Yeah? We may need to come prepared a bit so that we do it in one class and we end it. And perhaps if we can, we look at something slightly different to close that lecture. Guys, we are moving at a very terrible speed. And I acknowledge that simply because I want us to stay with some time for ourselves, okay? In the end, to recap some principles, some concepts, you know, things that you say when you're close to the paper, people don't always forget, okay? We are talking about ledgers now. This is Feb, isn't it? Beginning of Feb, we are talking about ledgers. And then someone, the next time to see ledgers is in an exam. In May, you get it becomes really, really challenging. So where you see me overspeeding, tap on me so that I go a bit slow. But I always recommend, if you have some time, revisit these videos. They help a lot. And that's the reason as why they are there on your package. Okay? Revisit them, conceptualize the principles. The last days will be for us to understand where our weaknesses are and how we can settle and compress those weaknesses. Okay? Otherwise, let's stop here. I wish you a good night until we meet again. Yes?
After balancing of your lenders and is it the same as adjusting the trial balance? Because some questions say adjust your trial balance.
No. No. Adjusting the trial balance comes after certain events have happened in the end, and you adjust them, then you come up with the adjusted trial balance. I think we shall see that. We shall see that. So much in suspense. All right, guys, have a good night. Thank you.